In early 2025, President Donald Trump reignited global trade tensions with sweeping tariffs on key trading partners. A 25% tariff on all goods from Mexico and Canada, along with a 10% tariff on Canadian energy products, shook markets. China also faced an additional 10% tariff on its exports to the U.S. But what does this really mean for the global economy, businesses, and everyday consumers? Let's break it down. Tariffs, tariffs, tariffs. Trump's tariff strategy is clear: protect domestic industries, reduce trade deficits, and bring manufacturing back to the U.S. Yet, tariffs act as a double-edged sword. While they aim to shield U.S. businesses, they also raise prices on imported goods. Costs inevitably pass to consumers. During Trump's first term, similar tariffs on Chinese goods made electronics and household items more expensive. With the 2025 tariffs being broader, the economic stakes are even higher. Global players aren't backing down. Canada and Mexico announced reciprocal tariffs on U.S. goods, hitting agriculture and manufacturing sectors hard. China, crucial in supplying minerals like germanium and gallium, essential for semiconductors, is poised to disrupt U.S. tech industries. Mexico's tariffs on U.S. agricultural goods could impact American farmers in politically sensitive states, adding a layer of political tension to the economic fallout. For businesses, the tariffs spell uncertainty. Companies are scrambling to adapt, but supply chain shifts are costly and time-consuming. For instance, a U.S. company previously spent $30 million over 3 years to move production out of China during Trump's first term. Now, with even steeper tariffs, similar adjustments could drain corporate resources. The auto industry, heavily reliant on parts from Mexico and Canada, faces higher production costs, likely pushing up car prices for consumers. Goldman Sachs estimates that metal tariffs alone will affect $50 billion worth of goods, raising the U.S.'s effective tariff rate by 0.4 percentage points. Higher production costs, inflation, and job losses loom, particularly for small businesses already grappling with tight margins. Financial markets have also reacted with volatility. The U.S. dollar has strengthened, while the Canadian dollar and euro have weakened amid fears of a prolonged trade war. In 2024, the U.S. operated a trade deficit in goods of more than $1.2 trillion with the rest of the world, but operated a surplus of nearly $300 billion in services. In 2024, the U.S. imported over $400 billion in goods from Mexico, China, and Canada, including vehicles, energy, electronics, and machinery. Other major exporters were Germany, Japan, South Korea, and Vietnam, each exceeding $100 billion in exports to the U.S., while the UK supplied $68 billion in goods. Trump's tariffs extend beyond economics. They're about geopolitical leverage. While aiming to bolster U.S. influence, they risk fracturing long-standing trade relationships and reshaping global supply chains. As businesses and policymakers brace for uncertainty, the pressing questions remain. How high will tariffs go? How long will they last? And how severe will retaliation be? Trump's tariff strategy may bring some jobs back to U.S. soil, but at a significant cost. Higher consumer prices, economic strain, and diplomatic tensions. As the world navigates this complex landscape, only time will reveal whether the benefits outweigh the costs.